Okay, so what we've got going on over here, the question, so we have 25 questions in total on the practice, and we have completed the ones that are crossed off. If for some reason you were skipping last time or you just slept through it, you can go back and watch the video for the ones that I have crossed off here if they were ones you wanted to know about. And then we have the ones that I have circled. These are ones that people have already told me they want to see today. So what I'm going to do is go through here and ask you question by question for the remainder are these ones that you want to see. And don't just hit the big button over and over again. Think about these. Does anyone want to see number 3? Okay. Does anyone want to see number 5? Does anyone want to see number 6? Okay, we have a winner here. 6. Does anyone want to see number 8?
Yeah.
Oh, okay. Does anyone want to see number 17? Okay. Does anyone want to see number 20? Does anyone want to see number 22? Oh, you're just doing that to mess with me. Do you really want to see it? Okay. He looked around and made sure no one else was going to ask for it. And he's like, okay, so apparently we're working everything except for, what, 3 and 5? So here we go. Number 1. Your company, by the way, start at the end. What is the firm's flotation adjusted cash flow in year 0? Oh, for shame, he's late. He did exactly the same thing last time. It's like he feels if he ducks that the shame will go over his head. It doesn't. Okay, so we're back to number 1. Flotation adjusted cash flow. So what we're talking about, remember we've got amount raised and amount needed. The amount needed is what you got what the money you have to have in order to do the project, but you have to raise more than that. Why?
Commission.
Yeah, it's the flotation costs that we have to pay to the investment banker. Okay, so now that we know what we're looking for, we can go through here and figure this out. Your company is considering a project that will cost $100. The project will generate after-tax cash flows of $39.50 per year for 5 years. Do we need that piece of information? Absolutely not. The WACC of the firm is 8%. Do we need that information? No. The firm's total debt ratio is 0.6. We'll probably need that to figure out our weighted average flotation cost. The flotation cost for equity is 7%. The flotation cost for debt is 4%. Your firm does not plan on issuing any preferred stock within its capital structure. So the only things we have to worry about are common stock and debt. If your firm follows the practice of incorporating flotation costs into the project's initial investment, what is the flotation adjusted cash flow in year 0? So here's what we need. So it's amount to be raised is equal to the amount needed divided by 1 minus the weighted average flotation cost. If that's not on your note sheet, it should be. Okay, then we know that the weighted average flotation cost is equal to the weight on debt times the flotation cost per debt plus the weight on stock times the flotation cost on stock. So they tell us the total debt ratio is 0.60. Where's that going to go in here?
Wait until I read that.
Yeah, it's the weight on debt. And what do we know about the weights? What do they have to add to? 1. So what does that tell me that the weight on stocks must be? 0.4. Very good. Okay, they tell me that the flotation cost for equity is 7%. And the flotation cost for debt is 4%. So I think that is 2.4% plus 2.8% is equal to 5.2%. Did I get that right? Okay. Now, in order for us to use this up here, we have to turn it into a decimal. How much do we need? Yeah, 100, the amount of our initial investment. And then we're going to divide that by 1 minus 0.052. So, how can you do that on your calculator? 100 divide by open parenthesis 1 minus 0.052 close parenthesis equal. I'm getting $105.49, which is the answer that they get. Any questions on that one? Okay. A firm's equity beta is 0.9 and its debt is risk-free. Given a 0.8 debt-to-equity ratio, what is the firm's asset beta? Now, when they tell us the debt is risk-free, what are they really saying? Yeah, beta is 0, right? Because beta is a measure of systematic risk. And if it's risk-free, then beta is 0. So that says that we don't have to use that first longer formula. We can use another formula. And in fact, they're asking us what's the firm's asset beta. And we know that the beta of the equity is equal to the beta of the asset times the equity multiplier. Do you guys remember that? Okay, how then would I get beta of the assets by itself? I'm going to divide by equity multiplier. So beta of the asset is equal to beta of the equity divided by equity multiplier. Have I blown any minds yet? Okay, now let's see if they give us anything that would allow us to find the equity multiplier. Oh man, they just give us the debt to equity ratio. What can I do with that to get the equity multiplier?
What's that? Equity, there's a 0.8 debt.
Okay, so we could do a lot of math.
Yeah.
Or we could just remember that the equity multiplier is equal to 1 plus the debt to equity ratio.
Yeah.
Because this is actually TE over TE plus TD over TE, which is just oh, for shame she's late. I can tell you this, she'll never be late to my class again. I hope. Okay, so that's how we get there. So now we know that what we're looking here is they tell us the beta of the equity is 0.9, and therefore and the debt to equity ratio is 0.8.
Yeah.
And so we're looking at 1.8 here on the bottom based on that. And so the beta of the asset is just 0.5. Is that the answer?
Yes.
Very good. Questions?
So if the debt wasn't risk-free, then it would be VA.
Oh my goodness. The beta of the asset is equal to the weight on debt times the beta of... Oh my goodness. Oh, I promised you long ago that if you showed up late again, I would fire you. You're fired.
Especially rushing from work.
Oh, he rushed. He's trying to tell me that he's got a job, right? So he fires. Okay, so it would be this. But what they're saying is that since this is risk-free, that basically goes away.
Okay.
Does that make sense? So, if I give you a beta of debt, this is the formula you need. If I don't, if I tell you that it's 0 or I don't mention otherwise, then you can just use this formula here. Questions? Okay. That was number 2. Now we're on to number 4. P&B Industries has 20 million shares. Oh, by the way, we always need to go down to the end and read. What is the WACC? P&B Industry has 20 million shares of stock outstanding with a market price of $19 a share. They have outstanding preferred stock with a market value of 40 million and 400,000 bonds outstanding, each with a face of 1,000, selling at 98% of par. The cost of equity, which you got to be careful here, it's the common equity, is 16%. The cost of preferred is 13%, and the cost of debt is 9%. And then they give us the tax rate and ask us what is the WACC. Now, this is an extension of our, oh, it's in my hand. This is an extension of our normal WACC formula. So here we go. The weighted average cost of capital is equal to the weight on common times the required return on common plus the weight on preferred times the required return on preferred plus the weight on debt times the required return on debt times what? 1 minus t. So just note that there is an extra term here because now we're juggling 3 balls instead of 2. Now the next thing we need to figure out is these different weights. And we're going to show that, or say that the weight on common is the value of the common divided by the total value of the firm. Well, what's the total value of the firm? It's the combination of that weight, or the value of the common, plus the value of the preferred, plus the value of the debts. And then the weight on preferred would be is equal to P over, any guesses? C plus P plus D. And the weight on the debt, what do you think it's going to be equal to? Yeah. Debt divided by C plus P plus D. Okay, so now we need to figure out, and these are all market values, by the way. Don't ever use book values. Don't ever use book values. Okay, so now we need to figure out what is C. Well, they tell us that they've got 20 million shares of common stock outstanding. So that's 20 million. And how much are those shares selling for a piece? 19. Okay, so I think that's 380 million. Does that sound right?
Yes.
Oh, very good. Okay, now they tell us how many shares of preferred. Oh, it just gives the whole value, doesn't it? Sweet. 40 million. And then the debt. How many bonds do we have outstanding? 400,000. And what's the face value of each one of those bonds? 1,000. And what is the quoted price of each of those bonds? Yeah, 98% of par, so we're going to go with 0.98. Okay, so this becomes 400 million, this piece does. What is 400 million times 0.98? 392. Very good. 392 million. And are we all in agreement on those numbers? Okay, now, here's something I want you to notice. This is in millions. This is in millions. This is in millions. Is there any reason for us to type out all those zeros? No, that stuff's going to cancel out when we get up here. And so now we can say, oh, I started too soon here. So this is going to be equal to 380. And by the way, let's go ahead and figure out what's this total value here. 380 plus 40 is 420, 720, 812, is that right?
12. Yeah.
Okay. Okay, so that's gonna be 380 divided by 812. And then P, the weight on P is gonna be 40 divided by 812. And the weight on debt is gonna be 392 divided by 812. Notice that the millions just cancel out. So here's what I'm gonna do. I'm going to, right now, I'm gonna figure out each one of these weights, and I'm gonna save them in locations, on storage locations on my calculator. And whenever I do that, I just write down the number and put a little circle on it so I can remember where I stuck that. Okay, here we go. Clear. We're gonna start with 380 divided by 812. I'm getting 0.467980296. Does that look right?
No.
No? Shall we try it again then? Dude, that's what's right.
It doesn't work.
So Mr. Nylon was wrong.
Oh, that's good, I'd already multiplied it by the,
Mr. Nylon, you're holding up progress, brother. Okay, store 1. Now the next one is 40 divided by 812. Equals, I'm getting 0.04926, does that look right? I'm gonna store 2. And then 392 divided by 812. And does that look right? I'm going to store 3. Now, here's a way to check your work on your weights. What must the weights add together to be?
1.
1. Recall 1 plus recall 2 plus recall 3 equals 1. So we haven't screwed anything up yet. Or at least if we did, we could still in a way that it still adds to 1. Okay, so now we have these numbers. And we are given the required return on the common, is that correct?
Yes.
16%? And for the preferreds, 13?
9.
And 9% for the debt.
Taxes.
Yeah, what's taxes, 30%?
40.
40. Oh my goodness, this must be a European country. Let's see, 1 minus 0.0, or 0.4. Okay, now what am I going to do here? I'm going to go ahead and do this math, and then I'll go ahead and save these things in locations 4, 5, and 6. And it may seem like it takes a little longer to do this, but the fact that you don't have to redo it is really nice. Okay, so here we go. Recall 1 times 16 equals, and I'm going to store that in location 4. Did I get the number right? Okay. Second one is going to be recall 2 times 13 equal, and I'm going to store that in location 5. Now this last one, what part of this should I work first?
Second.
Yeah, this part right here. By the way, the order of operations is PEMDAS, P-E-M-D-A-S. Please excuse my dear Aunt Sally. Parentheses, exponents, multiplication, division, addition, subtraction. And so we're going to do the parentheses first. And so I'm going to say 1 minus 0.4 equal, then I'm going to multiply by recall 3, and then I'm going to multiply by 9. Does that look right? I'm going to store 6. Now, what should I do to get the weighted average cost of capital? Yeah, I was going to add them together. Recall 4 plus recall 5 plus recall 6 equals 10.73%. Questions? see, that was number 4. So now we're on to number 6. Project A and B are mutually exclusive. Right off the bat, what does that tell us? We're not going to use IRR. We also wouldn't use profitability index, right? And so any one of these answers that mentions IRR, you can immediately just toss them in the trash, right? So we've really narrowed it down to you could flip a coin at that point. You've got a 50% chance of getting it right. Okay, project A, it costs $25,000. It's expected to generate cash inflows of $10,000 for 4 years. Project B costs $10,000. It's expected to generate a single cash flow in year 4 of $25,000. The cost of capital is 11%. Which project should you accept and why? By the way, for mutually exclusive projects, what is the only the measure we know works for sure? NPV, right? So that's where we're headed with this. In fact, we're going to have to calculate 2 NPVs. So we've got project A, and we've got project B. Year 0. How much is the initial investment for project A? Yeah, and it's negative, right? Because it's money flowing out. And then it produces cash inflows of $10,000 for 4 years. Project B costs $10,000, so that's minus $10,000, and it produces what?
0.
Yeah,
0 for each.
0, 0, 0. But in the last year, what do we get? 25,000. So now what we need to do is calculate the NPVs for these. Canada, what's up?
Stomach grab that was 1,000, like, this was.
Mine or yours?
Mine.
Hers.
Oh!
That's hilarious. Sorry.
That's hilarious. My wife and I have that problem at church, by the way. It's like, can you let us out a little earlier so we could go eat? And I'm sure you're thinking the same thing. Oh, okay. Okay, so here we go. How are we going to do this? We're going to use the calculator. We're going to use the cash flow keys. CF0 is going to be equal to what?
Minus 25,000.
Minus 25,000. C01 is going to be equal to what? 10,000. F01 is equal to what?
4.
4, very good. And there's nothing beyond that. Now, over here, CF0 is going to be equal to, well, I'll go ahead and write it down. CF0 minus 10,000. What's C01?
0.
Oh, very good. And what's that 01?
3.
Yeah. And then what's C02? 25,000. Okay, so let's get our calculators out. By the way, always, CF, second, clear work. 25,000, negative, enter, arrow down, C01 is 10,000, enter, arrow down, F01 is 4, enter, NPV. What's the rate here?
11.
11, very good. 11, enter, arrow down, compute. So I'm getting an NPV of 6,024.46. Is that what you guys get? Okay, now, what do we do next? Yeah, CF, second, clear work. CF0, negative 10,000. Enter, arrow down. C01 is 0. I'm going to go ahead and hit enter. Then arrow down, and F01 is 3. Enter, arrow down. C02, $25,000. Enter. What button do I hit next? NPV, and what do I type in now? 11. Enter. Now what do I do? Arrow down, and then compute. I'm getting $6,468.27. Is that what you get?
Yes.
Very good. Now, the goal of financial management is to maximize shareholder wealth. With mutually exclusive projects, I can only accept one of these projects. Therefore, which one would I choose? Yeah, the highest NPV because it creates the most shareholder wealth, right? What if they were independent projects? What would I do? Yeah, accept them both, right? Because they both increase shareholder wealth. Unfortunately, though, they're mutually exclusive, so we can only accept one of them, and it would be Project B. Questions? Okay, let's see, that was number 6. Compute the payback statistic for Project X and recommend whether the firm should accept or reject the project with the cash flows shown as follows: that the appropriate cost of capital is 9% and the maximum allowable payback is 4 years. By the way, do we need that appropriate cost of capital? Not at all. If I were asking you for discounted payback, which I would never do, then you would need it. Okay, let's get rid of this. So we're going to have time, and we're going to have our cash flows, and then we're going to create a column over here called balance. How much do we have to invest at time 0? So it's minus 100, minus 100. What's next?
No,
150, 150? Is it like this?
Time zero.
Oh, time 0 is... Oh, phew, thank you. Okay, here we go. Is that right?
Yes.
Yeah.
Okay, and then the next one is minus 100. And then time 2 is 150, and it's positive. What's time 3? 150. 0. 2,500. Okay, now I'm going to give you a hint right off the bat. If maximum payback is 4 years, is that 2,500 going to do us any good for No. Okay, so I'm going to start with a balance up here of the original amount that we invested. And then we're going to add the next year's balance to come up with the new balance. I've still got minus here, so how much is my balance for time 1? Minus 1,600. Now we start to go back the other way. What is minus 1,600 plus 150? Minus 1,450, is that right?
Yes.
And then we get another 150 here, would be minus $1,300, is that right? Nothing happens here, so that's minus 1,300. And then down here, we add the 2,500, and that brings us up to 1,200. Okay, I can already tell you that we are going to reject this project because this balance was still negative at the maximum payback. But they asked us also to figure out the number. And we said the way we figure out that number is we take the last year with a negative balance, and then we add the amount of money we owe, positive. The amount of money we owe, positive. 1,300 divide by how much money are we going to be making in the next year? 2,500. 1,300 divided by 2,500 is 0.52, I believe. And so this is going to be 4.52. Questions? Okay. me. Oh, look at that. It just killed off my stuff. Okay, now we're looking for number 10. Okay, when you see a bunch of stuff like this, of course, what we always do is look at the very end. And it asks, what change in net working capital happens at the end of year 1? So they're only asking for one single change in net working capital number. Now, when you go through here, you're going to be seeing that we've got all sorts of numbers. Do you think there's a chance that we're going to have more numbers than we need?
Yes.
Yeah, and that's why it's important to read what we need. So let's read through there with an eye toward net working capital. You're evaluating a project for your company. You estimate the sales price to be $40 per unit and the sales volume to be $6,000 in year 1, $9,000 in year 2, and $2,500 in year 3. The project has a 3-year life. The variable costs are $10 per unit, fixed costs are $75,000 per year. Project requires an initial investment of $25,000 in assets. The actual market value, net working capital requirements at the beginning of each year will be approximately 20% of the projected sales in the coming year. And so we're having to look forward. Tax rate's 34%, required returns 13%. Do we need either one of those?
Yeah.
No. What's the change in net working capital that happens at the end of year 1? Well, they tell us it's related to sales. So the first thing we're going to do is figure out our sales for each year. I think we just have 3 years, right? Okay, and they tell us how many units,
6,000.
6,000 in year, by the way, year 0, nothing, right? So that means this is nothing. So 6,000 in year 1, how many in year 2?
9,000.
9,000. And then in year 3? 2,500. And they tell us, yeah, the sales price is $40 per unit. 40 times 6,000, I'm thinking that's 240,000, is that correct?
Yes.
And then 9,000, I'm thinking that's what, 360,000? And 2,500 times 40, yeah, it's just 100,000, right? Okay. Now, let's figure out how much our net working capital needs to be in each of these years. They're saying it's 20% of what, though? Of the next year. So what's 20% of 240,000? Yeah, 48,000. And what's 20% of?
72.
Yeah, 72,000. And of course, we could do this one too, just for the heck of it. By the way, how much is net working capital going to be at the end?
7,000 minus 48,000.
Oh, so you're jumping ahead. I ask another question. How much is it going to be? How much is the net working capital going to be?
The same as
It's going to be 0, right?
Yeah.
It's going to go back to 0. Yeah. Okay, you're thinking about the change. You were calculating the change. Okay, now, it's asking us, what is the required change in net working capital at the end of year 1? So at the end of year 1, we go from 48,000 up to 72,000. So the answer is just 72,000 minus 48,000 gives us 24,000. Now, that was a lot of work, but it's not as much as the networking capital.
Can you just go back to that step?
To the last step? Okay, so at the end, by the way, cash flows always happen at the end of the periods, right? And so at the end of year 0, we have to have 480,000. At the end of year 1, we have to have 72,000. So what does that mean? It means we had to throw another 24,000 bucks at this thing at the end of year 1. And that's the question. What is the change in net working capital that occurs at the end of year 1? Because at the end of year 1, we go from 48,000 up to 72,000 in preparation for the next year. Good question. Other questions? Okay, that was number 10. Now we're on to number 11. Your firm needs a machine which costs $100,000, requires $5,000 of maintenance for each of its 3-year life. After 3 years, the machine will be replaced. The machine falls into the Macker's 3-year class life category. Assume a tax rate of 35% and a discount rate of 10%. If this machine can be sold for $20,000 at the end of year 3, what's the after-tax salvage value? I should have read that from the very beginning, right? ATSV is equal to, does that look right?
Yes.
Okay, now the book value at the end of year 3. By the way, so we're going to depreciate 33.33% in year 1, 44.45% in year 2, 14.81% in year 3. Now, what I could do is try to add all those together and then multiply by the initial cost and then subtract that from the historical cost. What would be an easier way to handle this?
Use the 4%.
Yeah, year 4 is the amount that's left to be depreciated. By the way, that, since we're going to 0, that means that year 4, that 7.41% is our book value that's left over. It hasn't been depreciated out yet because after year 4 it would be down to 0, right? Okay, so to find this book value, all I'm going to do is say 0.0741 multiplied by, what was the historical or 100,000? Oh, I'm just making the math way too easy here. 7,410. So that's your book value. Now, what is the market value?
20,000.
Yeah, 20,000. And so 20,000 is going to go here, but it also goes here. And then what do they tell us the tax rate is? 35?
Yes.
Okay. I'm going to put that as a decimal. Okay, so here's what I'm going to do. I'm going to start out doing this, and then I'm going to multiply by this. I'm going to hit my negative plus minus button, and then I'm going to add 20,000. That's the quickest way to do this. $20,000 minus 7410, is that right? Equal to 12,590. Now I'm going to multiply by 0.35 equal. What button should I hit next? I'll give you a hint. Yeah, this thing has to be negative, so I'm going to hit the plus minus button, and then I'm going to add 20,000. That's going to give me $15,593.50. If you had gone to the trouble to figure out the depreciation for each year and subtract it out and get down, you would have gotten exactly the same number, but it would have taken you longer.
If we ask the after-tax salvage for year 2, so which category we're gonna use the year 3?
So if they asked for the after-tax salvage value for year 2, what we would have done is, so there are two ways we could go about it. We could either add those first two together, figure out the depreciation subtracted from the initial value, or we could just add those second two together and multiply it by the historical cost.
Okay.
Because in that case, the amount that's still left to be is those last
It's
two.
not depreciated fully, so we cannot use the third year macros.
So you would just add both the year 3 and the year, so here, when we only had 1 year left,
Yeah.
we just used 7.41%.
Yeah.
But if we had 2 years left, we would use 14.81 plus
Okay.
4.71.
Okay, thank you.
You're welcome. Other questions? Okay, that was number 11. Now we're on to number 12. Suppose you have a fixed asset, you sell a fixed asset for $79,000 when its book value is $119,000. The company's marginal tax rate is 40%. What will be the effect on cash flows of the sale? And once again, we're looking at the after-tax salvage value. I think this one's actually easier, but it blows your mind because of sign, perhaps. You sell a fixed asset for $79,000. What's the tax rate?
It's 40.
40%. 79,000 here. Ah. Minus what? 119,000. Okay, here's what blows people's minds. This is minus 40,000, is that right? Minus times a minus is what? Plus. And so we're going to get a tax rebate. Why? We've under depreciated the asset, so we've overpaid our taxes. That's why we get a tax rebate. I think 0.4 times 40,000 is what, 16,000? So we've got our 79,000 plus 16,000 gives us 95,000. That is the correct answer. This is the trick, folks. Minus times a minus is a positive. That turns into a tax refund. When do we get a tax refund? When the book value is greater than the market value. Why? Because we've under depreciated the assets and overpaid our taxes. Questions? Okay, moving on to number 17. The following data on a merger is given. What will be the post-merger price for firm A's stock if firm A pays in cash? And then they tell us that the total value firm AB is $11,200, which represents a total value in a stock acquisition where all value remains in the firm. Okay, so let's talk about this value of firm of V, A to B is equal to, it's telling us 11,200, right?
Yes.
If I pay cash, what will be the value of the firm after? In a cash merger, it would be 11,200 minus the amount of cash that flows out. Yeah, and how much is that going to be? It's going to be, yeah, it's the number of shares outstanding, and how much are we spending on each share? 20?
Yes.
Okay, very good. And so that's 11,200 minus 800 is equal to 10,400. Is that right?
Yes.
Now, how many shares? By the way, what happens to the firm B shares?
It's gone.
Yeah, they're just gone. And how many shares does firm A have? Still has 100 shares. So all we need to do is divide by 100 there, and that tells us that the shares should be trading at $104 now. We could have made that much harder. I'm glad we didn't. Questions? Okay. Number 19. Firm A has a value of 100 million, firm B has a value of 70 million. Merging the two would allow a cost savings with a present value of $10 million. Firm A purchases firm B for 75 million. What's the incremental gain? It's just the 10 million, right? Remember, we talked about the sources of gains for mergers, and one of them was cost reduction. And they don't mention any other. So that's it.
So what is this? Sorry, I missed it.
Oh, okay, let's,
We didn't-
I flew too fast for you there. Okay, so when we put two firms together, the incremental gain could either be a cost reduction, an increase in revenue, improved marketing. I mean, there's all sorts of things that can cause this incremental gain. And so when we read through here, the only one of those that we see is this cost savings with a value of 10 million. That's the only incremental thing that we see in here. And so do we actually have to calculate all that other crap? No, you just have to read and know what you're looking for. Once again, I should have started at the end by asking, what are we looking for? Now we're moving on to number 20. Number 20 says, how much do firm A's shareholders gain in PV from this merger? So we've got firm A and firm B here. Merging the two would allow a cost savings at the present value. So hey, this is the same stuff, right? Okay, so here we go. The formula for NPV is equal to VB star minus delta V. VB star is equal to the standalone value of, minus the cost to A to acquire B. Okay, VB star is VB plus delta V. Now, if they truly pay VB star for this thing, they're going to give all the gains to the target shareholders. What's the goal of financial management? Maximize shareholder wealth. If you are the CEO of the bidding company, which one should you be concerned about, the bidder or the target? Bidding, right? You should be concerned about your own shareholders, and that's what we're trying to figure out here, this NPV, this is NPV to A. Okay, what's the standalone value of B? 60 million? And what's the delta V? Yeah, it's at 10 million. So that's equal to 70 million. And we can go back up here and put in 70 million, and we're subtracting out the cost A to acquire B. How much is that? 65 million. And so that is 5 million in total. That's what we get. That's what we get. Now, if we were told the number of shares for firm A, we could divide the NPV by that number of shares and figure out what's the increase going to be in the price of firm A's shares. But we weren't given that information. Questions? Okay. Oh, now we're into the options. Oh. You purchase one IBM July 120 call contract for a premium of $6. You hold the option until the expiration date when the stock sells for $122 per share. You realize a blank on the investment. Okay, we know that the value of a call is the maximum of the stock price minus the exercise price, or 0. And we know that on the day that this thing expires, how much is the stock price? 122? And what's the exercise price? 120. So which one is max there? Is it going to be this or this?
2.
Yeah, it's going to be this, so it's 2. And so the payoff of this thing is equal to $2 per share. And we could go ahead and multiply by 100. Why am I going to multiply by 100?
Option is only 100.
Yeah, there's 100 options in a contract, so times 100. So that's going to be bringing in $200. But how much did I pay for this? How much did I pay for each option? $6. Times 100 is equal to $600. And so I'm going to subtract out the $600 that I paid for this thing. And that's going to tell me that I have a loss of $400. Questions?
So, I was busy. Can you communicate with that from there?
Okay, so did you get why this is just 2?
Yeah, from there.
Okay, so how many shares in a contract? 100. Now, we could have done this multiplication at the end, but we're going to do it now. So when I get my $2 per share on my 100-share contract, I receive $200. You're feeling pretty good right now until you realize that you paid $6 a share for those options, 100 shares worth. You paid $600. So what was your true profit on this thing? Your true profit was the $200 you received from the option at the end from exercising it, minus the $600 you paid, and so you actually end up losing $400. Does that make sense? Okay. An investor is bearish on a particular stock. What does that mean? They think the price is going to go up or down? Down. If they were going to be going up, what would they be? Bullish, right? Decided to buy a put with a strike price of $25, ignoring commissions. If the option was purchased for a price of $1.85, what is the break-even point for the investor? For a put, the break-even is always the strike price minus the premium. For a put, the break-even is always the strike price minus the premium. For a call, the break-even point is always the strike price plus the premium. For a call, the strike price is always the break-even point is always the strike price plus the premium on the option. And if you go back and look at those payout or profit charts, you can see that. Okay. Woohoo, one more. I think we're going to do it. A put option has a strike price of 35 and a stock price of 37. The option is trading at $2.25. What is the time or speculative value embedded in the option? Okay, let's do the same thing here. So we know that the value of a put is equal to the maximum of the exercise price minus the stock price. It's just flipped from the call, or 0, whichever is greater. What's the exercise price here? 35. What's the stock price? 37. So this thing is -2, which is larger. -2 or 0? 0. And so this thing, the intrinsic value is 0. The intrinsic value is 0. And we know that the premium is equal to the intrinsic value plus, the speculative value. And we know the intrinsic value, we know the premium, so all I have to do is rearrange this. The speculative value is just equal to the premium, minus that intrinsic value. How much is the premium? $2.25. How much is the intrinsic value? 0. And so the entire value of that thing is speculative. Now, here's the way to think about this. If it's out of the money, the entire premium is due to speculative value. If it's out of the money, the entire premium is due to speculative value, because if it's out of the money, the intrinsic value of that option is 0. Do you guys remember out of the money and in the money? It's got a positive payoff, it's in the money. If it's got a 0 payoff, it's out of the money. Questions? Wow, I think we did it. Any general questions before I kick you loose for the rest of your lives, hopefully? No? Okay, well folks, I have appreciated you being such a good class, and I look forward to having some of you in my Fin 790 seminar.